All right, options traders, listen up. I want to tell you a bit about public.com. But first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or pre-contract fees. And in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 option contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. So to recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for options trading, and start earning up to 18 cents per contract traded only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only.
Hey friends, welcome back to Investing Unscripted, where we ask the hard questions about investing. I'm Jason Hall, joined as usual by my good friend, the voice of the people, Jeff Santoro. Jeff.
Hey, how are you, friend?
I'm quite well. I'm good. We're getting some nice hot weather in the Northeast. That's a big change for me, is like adapting to the fact that we don't really get nice weather until it's almost June.
Yeah.
It's almost June. You get nice weather.
Yeah, I was disappointed with May. It was pretty rainy and cold here in Jersey. So yeah, these last couple of days of sunshine and heat have been a welcome change in my book.
Yeah, I should have sold in May and went away to somewhere warmer. So, all right. Well, speaking of selling and taking investing actions, we have a great show lined up. And this is interesting because it's related to a lot of the things we talked about on the periphery. You wrote recently about your year of not selling and thinking about that strategy. So the title for this week's episode is How to Be a Successful Stock Seller.
Yeah, you usually hear that beginning of that title ends in something like investor or buyer, but we're going to talk about selling today. And yeah, like you said, I wrote about this in the newsletter this past week, which will be more than a week away from when people hear this. And our good friend and YouTube channel contributor, Tyler Crow, reached out to us and thought it might be a good idea to spend a little more time talking about selling. And I agree. It's timely when I think it's even timely in terms of how the market's going right now, because you're probably seeing a lot of all-time highs in your portfolios. At least I know I am with some stocks.
Mm-hmm.
And, we spend so much time talking about buying and holding and making good decisions. We don't spend as much time talking about when to sell. And it's been on my mind because of what I wrote about. So I think it's a good time to revisit this. And we did do one other episode on selling. It was actually episode 27, way back in November of 2022. So if anyone wants to hear our thoughts on selling from a couple of years ago, you can go back and check that out. It's called Is It Time to Sell Stocks? That was a little bit more about what the market was doing, I think, if I remember correctly, and then our thoughts on selling. But
yeah, so it's a good time. It's been, a year and a half since we recorded that episode. A ton has happened. The market has actually done really, really well since then. Like I said, near highs. But the thing I think that's really important about this topic, and we're getting into the specifics, is there's lots of reasons to sell stocks. Frankly, only a few of them are probably good reasons at the time that people choose to do it. So we're going to kind of break this up a little bit, and we're going to talk about the reasons people sell stocks, when we think they're good reasons and when we think maybe they're not necessarily good reasons. So you want to kick that off?
yeah, and I think what's going to be interesting, at least for me, and I don't know how you feel about this, Jason, we didn't discuss this ahead of time. I feel like I've gone through like 3 or 4 or maybe even 5 different phases of how I think about selling over the 4 years that I've been buying individual stocks. So it'll be, at least for me, and this is all that actually matters in my book, is me. It'll be fun to talk through it just because I'm in the process of rethinking what I think about selling again.
Jeff, you've been going through the investing stages of grief. I just want to
yes, whatever those are, I've been going through them.
Yeah.
All right, but yeah, as you said, we're going to start off by sort of listing / talking a little bit about all the different reasons we think people come up with to sell. And we're going to bucket them into, I guess we're going to talk about like what we would consider to be the worst reasons and then transition to the best reasons. So we're going to start with things that are probably not good reasons to sell. Then we're going to talk about some maybes, right? Reasons that could be a good reason to sell if you have some sort of process behind it. And then we're going to talk about the reasons that we think are perfectly legitimate to sell. So let's start with a couple ones that we think are some bad ones. And we wrote this on the outline as stock go down, stock go up, stock go down, then up.
Right. Right.
Which is,
and I really do think, go ahead, Jeff, go ahead.
yeah, I was just going to say that, which is just a quick way to say people who are, making decisions solely on price movement is probably not a good reason to sell.
And it's the number one reason people sell stock, and because fear and greed, right? Those base emotions, it always comes back to that, where we're reacting to what the market is doing with the stock price versus being mindful about owning businesses and thinking about our financial goals and focus on the thesis of the business. So the way I describe like this whole category to me is it's like wagging the dog, right? The tail wags the dog. So the stock price is wagging the dog, which is your portfolio. And yeah, stock go down, stock go up, stock go down, then go up. So volatility is scary, right? It's a scary thing. And I think the second worst reason to sell a stock is because it went down, just because it went down, because there's no thesis tied to that of business performance that you're considering. The worst reason is because the stock went up, right? And usually if you're selling because the stock went up, you're afraid it's going to then go down. So you want to get out, right? At the top. So those are typically very emotion driven things.
And let's dig in a little bit on that, because I think when you're a newer investor, it's very common. I remember hearing people say, and this struck me as logical at the time, and until you kind of learn more, I totally understand how people think this is a brilliant, foolproof strategy. The whole idea of when it goes up this amount or when it gets to this price, I'll sell, and then I'll use those proceeds, so to speak, either to count as gains or I'll reinvest them in something else. And if I always sell after it goes up, I'll never lose money. Right. And I know people who have, percentage and, it goes up 20%, I'm selling it. It doubles, I'm selling it, whatever. I think if your only goal with investing is to simply not lose money, then I actually think that could work, but I don't think that's the reason you invest. And the reason is, just in case anyone doesn't know, like why we think that's not the smartest move in the world, is because you don't know that thing that you sold because it was up 20%, it was up 30%, it was up 200%, it was up 300%, could end up being that stock that goes up 1,200%, 3,000%, 10,000%. And investing is riddled with stories of people who sold this stock, at this point, and then it 10 bagged after that, and those types of things. So what's the Charlie Munger quote, or the Warren Buffett quote? The best thing to do about compounding is not interrupt it.
Yeah. Right. Exactly. And that's why I quipped that, selling a stock because it's gone up is the worst thing to do. That's even worse than selling a stock that's gone down, is because, and again, this is all theoretical stuff, but your losses are capped at 100% if you're not using leverage. Your gains are potentially unlimited, right? We know that's not always real, but the point is if you sold Amazon, half your Amazon that you bought in 1997, when it doubled because you wanted to quote unquote take money off the table, right? Say, okay, now it's all house money. Like, I hate those terms because you turn every aspect of the way you think about investing into gambling, which is, I think, an unhealthy way to think about it, because you completely throw all the business realities out of it. And then you missed it. And then even if you held that half, you would have done perfectly fine, right?
Right.
Over the next 25 years. But you miss so much opportunity, right?
And it's
for upside returns for no other reason than an arbitrary thing that you've decided to do, right? It's an arbitrary rule. It's not a framework that's based on your goals, what you own, your long-term plans, your psychology. Like, it's just an arbitrary, stupid ass thing that you heard somebody said that sounded good. And just because an idea is tenacious doesn't mean it's worthy. So drives me crazy.
And we're going to talk more about this, because I think what's the fun part of this conversation is all of the things we're saying are bad reasons to sell could be good reasons to sell if And we're
Yeah,
going to talk
right.
about what those ifs are.
Yeah, exactly. Because I think all of these things is when you're putting it when this is the end point that you act on versus maybe the beginning of your further research,
Right.
right? I think
Well, and
that's the key.
it's also like what you don't know. Like, again, when I remember when I was brand new at this, I was I was mostly buying penny stocks unintentionally. I didn't know what that was at the time, and it was I've told the story before, but I think I started with a Robinhood account with $50, and there was no fractional trading at the time, so I was forced to buy 2, 3, 4, $5 stocks because I wanted my $50 to go as far as I could. And when you're trading those kinds of stocks, you get a lot of volatility. And I remember seeing something go up 30% in a week or a couple weeks, whatever, and thinking to myself, oh my God, this is insane. Like I can't, I got to sell this because I had no idea
Right.
that it was just a volatile stock. I had no idea stocks could go up 10,000%. Like none of these were going to, but so
Well,
I
you
think
didn't
the
even know
point,
what you owned
no,
at that point in your
yeah,
investing career.
no, I knew I was buying 4-letter combinations that were,
Yeah.
you
Right.
know, within my $50 budget.
Let me
So I
throw
think
one
with all,
caveat in here. I want to say this. I meant
yeah,
to say it earlier, and I think it's important to mention is that there is an entire class of investors that do this, that do very, very well. There are plenty of traders that they initiate a position and they have a target price and a period of time, and they have a loss threshold. Like if they buy that stock and they're anticipating within the next several weeks or months or sometimes even days that they're going to get this return. As soon as it gets to that point, they exit. They do it. But these are also people that are doing a tremendous amount of research to make these decisions, and they're looking at momentum and price action and sometimes factoring in valuation and earnings dates and macro data, like all of these things that they're kind of building their trading around that do very, very well. Typically, you're talking about high percentage moves too, like the people that, their accuracy rates can be very, very high. And if you're consistently accurately getting, if you're 70% of the time, you're making a 15% gain on a 6-month trade, you can make a lot of money, right? As an investor. That takes a tremendous amount of time and a tremendous amount of discipline. And that approach is not what you were talking about, right? It's entirely being led by emotion and price action and not having a plan.
right. Yeah. I think the bottom line with this whole category is, like you said, the price wagging the dog or the price wagging the stock or however you want to look at it is
Yep.
basically about making a decision based on nothing other than the price.
Yeah, and there's other parts of it too. So like a couple of other things that jump to mind. It's like I read a headline, right? Maybe a short report came out or something like that. And there's plenty of people out there that they have like a hard line in the sand that if a short report comes out and they own the stock, they get out as quick as they can. They feel good about doing it. They feel better. It's like, oh, I've gotten out of that. But then you start digging into like the underlying data about like the accuracy of short reports and then price action of stocks within 30 days of that, and like the number of stocks that actually are flat to up from that period.
Right.
Usually all they're doing is they're just transferring their money directly into the pockets of the people that shorted that stock. So another one is just the kind of the law of large numbers fallacy. It can't get any bigger. Apple, Microsoft, NVDA. That's a big one. It's overvalued, which I think is just a proxy for, man, this stock's really gone up a whole lot and I want to get out now before it falls.
And that's where you see, again, if you're selling because it really is overvalued and you have like a actual basis for that, we'll talk about that later.
Yeah.
But in this bucket, it's the conflating overvalued with a high stock price, right? And not having any information behind why the stock has gone up that would lead you to believe it is overvalued.
Well, it's like in late 2021 when a whole lot of growth investors turn into value investors, right? When the market's heading down. So, and another was like, it's a dead stock. It's a stock that just kind of has gone up and down a little bit, but it's a lack of patience. You don't see, maybe the business results haven't translated to the stock price moving up, but all you know is the stock price hasn't moved up and the market has. So it must be a dead stock. So all of these reasons add up to generally, yeah, the stock price wagging the business.
Yeah. All right. So now let's move to reasons to sell that maybe could be an indication of having some sort of progress or process, right? So like maybe ones we put in like a middle category. So like one that I had in mind was tax loss harvesting.
Yeah.
Right. So talk a little bit about that.
Yeah, so this is one where, I mean, it can be a smart way to leverage tax benefits. So again, the idea is that you get close to the end of the year is typically when people do it. Sometimes you do it at the beginning of the year from stocks that are down, just depending on your process, where you own stocks in a taxable account. They've lost value from what you paid, and you sell with the idea of locking in that loss to reduce your tax exposure. There's a certain amount that you're able to do against long-term gains each year and short-term gains, and then you can carry over a certain amount as well. So the reality, though, I think a lot of people, Jeff, they use it as an excuse, like it's justification
Yep.
to sell a stock that hasn't performed without actually again bothering to do any business analysis. But it could be a really good way to do it. Maybe you've reached a financial goal with another stock and you sold at a big gain, and you want to offset some of those gains, right? So tax loss harvesting can be a way to offset gains as well. Again, is it part of maybe a process, or are you just using it as an excuse to do something?
And I think that's the question. And look, I've done it. I've sold stocks, and my stated reason to myself or to you or whoever, or the podcast audience, has been, I did this for tax loss harvesting. And I think if I'm being honest with myself, sometimes it probably was an excuse. It's something I wanted to sell, and just this was the reason to do it. But, I think maybe the first couple of years, it was more that. And I think over the last couple, maybe it's gotten a little bit closer to but I do actually have legitimate reasons. And this is just sort of a good time to pull the trigger, so to speak.
Yeah.
But yeah, so that's why I think we put it in the bucket of there might be a process behind it. So another one is the position is now a really large portion of your portfolio. So in what ways might that be a process, and in what ways might that not be an indication of a process?
So this is one that can kind of fall over a number of different realities. The first one, and I think the most important one, is financial. And there's a big difference between a 30-year-old investor, a 45-year-old investor, and a 60-year-old investor, where percentage of your portfolio can mean very, very different things. The average 30-year-old, if they bought NVIDIA a couple years ago and now it makes up 60% of their portfolio is probably really small compared to their long-term goals. And selling NVIDIA just because it's become 60% of their portfolio, when just investing into other things instead over the next 3, 5, 10, 20 years, may be the better approach. That's really different if you're 60 and NVIDIA makes up half of your portfolio, because that means it's 40% of your net worth when you factor in home equity and other stuff, and you're 5 years from retirement, right? And now we're talking about if Netflix pulls a GE circa 2000, or even a Microsoft, which is still a really, really good business, but because of valuation reasons and just the overall growth trajectory, you still lose a hell of a lot of money over the next decade. It could cause material harm to your ability to reach your financial goals, right? Those are very, very different things, right? So thinking about it just from the hardline financial impact, but then that 30-year-old investor, maybe the issue is that they get up every morning, as they're making coffee, they're seeing what NVIDIA is doing in the pre-market, right? Because they're worried, not because they're interested in it and compelled and it's fun and they enjoy it, but because they're afraid they're going to lose a lot of money that day. That's a situation where you need to manage yourself a little bit. And even though NVIDIA could continue to perform really well over the next 5 to 10 years, maybe reducing your exposure to that just is better for your brain. Then it's definitely a process thing.
Yeah, I also think if you're at the point where you really do feel like an individual stock is just too big of a portion of your portfolio, and I know you mentioned the age thing, but I think this could happen. This could happen quickly for a young investor, because you might have fewer stocks. And if you get lucky and have one that pops, 300% in 1 year, like we've seen happen, like NVIDIA, I think is up some crazy 3-digit amount in just the past year.
Yeah.
You could get to a point where I only own 10 stocks and now NVIDIA is 40% of my portfolio. And that could make you feel uncomfortable. But I think what this made me think of, and this is where the process could help you. Without a process, you might just say, I got to sell NVIDIA. It's too big. And you might be right. But with a process, you might say, I need to put more of my money in some other stocks and, lessen.
You just decrease your exposure by growing
adding other stocks.
exposure to other things. Yeah.
Right.
Right.
So that's
Yeah, exactly. Now,
another way.
and I think this I want to just build on this a little bit more because I think it's really important. Anytime you're selling a stock, so this isn't just for the reason of now it's done really well and it's a big, this is definitely like an extreme version of stock goes up. It's also really risky. I think a trap that a lot of times we lead ourselves down, especially when we sell those businesses that we love, that we still have the ability to see them continuing to be big winners, but we still take some off the table or reduce, like whatever you say. And we're thinking in the back of our head, or even sometimes we're planning, it's, I'll just buy more when it's 20% less. Like it's some fait accompli that it's going to fall, right? It's going to fall. So I'll just buy more then. And then we anchor, right? We anchor on the price that we sold, and then it's up 10%, and then it's up 20%, or it's up 50% 4 or 5 years later. And we never added because we were so focused on anchoring on where we sold that we weren't objectively thinking about valuation and addressable market for this business and how can it grow and what are the opportunities. We're so focused on where we sold and being right. We're so convinced that we were right and we're going to be right because it's going to fall, that we can buy at that, what we say is the right price, even though it never comes. So it's really hard. We wire our brains to lie to us about that kind of stuff. So I think that's another thing that's really important about having a process.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the past 10 years? FinChat's got it. Do you like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat all the time and I love it, especially for checking out the KPIs of all the stocks in my portfolio. To get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Yeah, agreed. So another one that we wrote down on our list here is you have a stock that you bought on borrowed conviction and you're either not interested or willing to build your own conviction for that stock.
So I've talked about this before. There's lots of good subscriber-based stock research out there. We've had folks from a number of those shops that do good work come on our show. And there's a couple of ways to treat it. The one is like it's a jumping off point for you to do your own research, or you just blindly buy everything they recommend because their track record says that you're going to get good results if you just do that. And you can borrow conviction and just do that if you're wired the right way, like once a month or once every 6 months or whatever. Whenever you get information from them about stocks to buy, you just do it and you log in and you do it. And then, once a year you check and make sure, like, is it still working? That's one way to do it. If you're not fully committed to not borrowing conviction, but buying conviction, right? Doing it that way, you have to find your own conviction, right? You could borrow conviction for a while, but at some point you have to find your own conviction, whatever that takes. And generally, Jeff, this is something you've talked about a lot, is having a process where you're constantly putting yourself in touch with that company on a regular cadence. Like for you, it's the quarterly results and just filling out your spreadsheets with the KPIs, reading management's commentary, holding them accountable, thinking about valuation, where you're building like that foundational knowledge about the business. It's perfectly reasonable if you don't have the interest or time to not own those businesses. If you can't own them based on buying somebody else's conviction to do it. I just think the challenge is that if unless you're like you, Jeff, where you're managing a small portion of your portfolio in individual stocks and the rest of it's going into ETFs, there's nothing in the world wrong with just owning all ETFs and not having to dedicate the time to do research in individual companies.
Yeah. Yeah, I agree with that one. And I think too, like, again, this is one of those ones where if you're not honest with yourself, you can use the borrowed conviction thing as an excuse to either buy or not, or either to sell or hold. And I think that's again where, there are stocks in my portfolio I bought entirely on borrowed conviction that I've grown to have my own conviction in. And there are stocks I still own that I don't necessarily have that conviction that I bought on borrowed conviction. And there's a bunch I've sold because I never had my own conviction. So I've been all over that gamut. And again, I think when I was newer, I probably used that as an excuse. Oh, I never really wanted that anyway. I just bought it because I didn't know what I was
Right.
doing. And I think I'm trying to be a little bit more, and this goes to what I wrote about a couple weeks ago in the newsletter. I'm trying to be a little bit more, put some friction points between my desire to sell and my actual selling so that I can kind of be honest with myself about, is this really that I'm not developing my own conviction, or am I just using that as an excuse? Um,
Introducing more friction on the in between you and selling and in between you and buying, I think is one of the most powerful things that most people can do to improve their returns. I really do. I want to build one more point on the idea of conviction because I think too much conviction can be just as bad as too little conviction because again, our brains are amazingly good at lying to us. I mean, that's why people run marathons, right? Because their brain convinces them. Your brain will convince you that it's like an actual fun, good thing to do and gives you all these weird hormones that make you feel good at different points, even though you're absolutely destroying your body while you're doing it. But I think that the key is so two things. One of my favorite quotes, and it really this kind of sums it up. We mentioned Tyler Crow earlier. I think he was on a show with us when he said it's like having enough conviction not to sell. Like that's the perfect balance of because you always want to be skeptical of even the very best stories or the management teams that are the best at telling those great stories. So you always want to have that little bit of skepticism. And it's what's a strong convictions loosely held. As an investor, you have to always be willing to change your mind quickly when there's evidence that you're wrong, right? Because you could always build a wonderful case to support a bull thesis about even really, really bad businesses. I do videos about Plug Power and I hear these wonderful stories about the bull case for a terrible business all the time. It's a lot, you become a lot better when you are challenging your bull case. So strong convictions loosely held or enough conviction not to sell is probably a better way to think about it than high conviction.
yeah, I like both of those phrases. All right, last one in this category of reasons to sell that may or may not have a process behind them is that the stock is not one of your best ideas and you have other ideas that you want to allocate to.
It's interesting because this is actually this is becoming something that I'm having to face more and more. I made the decision over the past year to increase my cash position to about 10%. As we've gotten to a point now with interest rates, we can actually get a pretty reasonable rate of return on cash versus the stock market's long-term average performance that I've decided it makes sense for me at this stage to hold more cash. As a result, that means that I have less cash that I can actually deploy into my best ideas. So I'm getting to the point where I'm having to be more and more thoughtful about exposure to different stocks, selling stocks that just they're not delivering to free up cash. So I have more cash to invest where I do have higher conviction. I'm curious to hear from you too, because I know this is something you've kind of, to a certain extent, you've dealt with at different times because your process in the past was you were the guy that invested every week, right? You put that money in, you bought something, you put that money, you bought something, and you've changed to investing a little less often. So I'm a little curious, like, how have you thought about this?
Well, I like what you said about you're being forced to sell some things because you have better ideas. Like the slowdown of cash into your portfolio has forced you. And I think that's a position that people who are retired have to face all the
Right,
time. So if we have any
right.
listeners who are like living off their portfolio, I know we have at least one or two just because they're friends of ours. That's a decision you have to make all the time.
Mhm.
If you think stock X is your not the actual ticker X, but if you think a certain stock is the best thing out there and you want to buy it because you think it's this awesome, incredible opportunity and you ain't got no cash, you're going to have to sell something to do that. So,
Right.
and it brings up something I think we're going to talk about later. So I don't want to get too deep into it, but it brings up the whole idea of what do you do with the cash after you sell the stock? And, you could make the argument that if you could guarantee that the cash from every sell went to a opportunity that got you a higher gain in the long run, like then selling is no brainer, right? You're allocating to a better opportunity. The problem is we can't see the future and don't know that. I think for me and my portfolio is I'm of two minds of this. Like I do have a limited amount of cash I'm putting in too, because the bulk of my invested retirement money and and almost all of my wife's goes into our retirement accounts, like her 401k, my 403b, which is just index funds. So what's going into individual stocks is sort of just the extra, if I can put it that way.
Yeah.
So there are times when I want to buy more things than I have the cash for at the moment. And that's when I start to think, oh, should I sell this? Should I sell that? And this is where I find myself not having a process, right?
Right.
My process is greed in that moment.
Right.
I want to
Right.
buy more things and I don't have the money. And this stock sucks anyway. And I've always hated it. So I'm going to sell it, right?
Well, and that's the
Um,
thing, right? Because that's exactly what happens. Our brains
yeah.
start lying again, right? It starts justifying, and usually the stock price wags the dog, and we find our biggest loser that for whatever reason we have so there's some value there, and it's like, okay, I can just take that. But it's like doing this, Jeff. It's 4 times harder. It's 4 times
Yeah.
harder.
And I want to give an example of where someone I know or people I know who do this, and I think they have a good process. So our friends Ryan and Brett, who do the Chit Chat Stocks podcast,
Mhm.
you guys have heard them on this show a couple times. We've been on their show a couple times, and I've heard them talk about. Now they are younger guys who research stocks like full time. That's like what they spend all their time on. They have concentrated portfolios, and I've heard them talk about keeping a very long watch list and only buying it if it's an idea they like better than what's in their portfolio, right? So they have this sort of built-in process of a constant competition, so to speak,
Yeah.
between however many stocks they currently own and however many stocks they find attractively priced on their watch list. And I've heard other people talk about that, the whole idea of I don't add anything into my portfolio until I find something else that, gets bumped out because it's the lowest on my ranking of good ideas at the time.
Well,
And
and
I,
it's interesting because you talk about Ryan and Brett as like, professionally they this is part of what they do, and younger guys, no kids at this point, they have more time to kind of focus, and they're really passionate too, right? So that confluence of things. The interesting thing is on the other end of the spectrum, our good friend Brian Withers. Brian's an empty nester. He's semi-retired. He has lots of other interests and pursuits in his life, even though he spent the past 30 years buying and selling individual stocks. He also runs a concentrated portfolio, but for a different reason. He doesn't want to spend as much time, right, following every company that he owns. And the threshold for him, similarly, even though they're doing it for different reasons, different motivations, similarly is that high bar of, if you're going to come in, I got to throw somebody out, and you better be prettier than them for me to swap you out. So it's really an interesting approach for different reasons that people can take over time.
yeah, but I think the bottom line with both of those examples is there's a reason and a process. And I
Yeah.
think that's what we're driving at here, right? If you're selling because you have a better idea and you have a process that leads you to that decision or that conclusion, that's a good thing. And if you don't, and you're just jumping to the next shiny object, that's where this reason to sell would be, in our minds, not great. All right. So
Yeah. And just remember too, you have to be right twice when you do.
yeah,
When I say it's 4 times harder, that's why, because you just don't have to pick the right winner, but you have to remember that there's a result from what you're selling where you right to sell that business and then reallocate that capital into whatever your better idea was.
all right. So let's now pivot to reasons to sell that we think are good / probably have some sort of process behind them. So the first one, I think we touched upon it a little bit, but it's basically the idea of, moving from stocks to, capital preservation assets, things that are going to have less volatility, be more likely to not just crash quickly because you need that money soon. So this would be someone who's in retirement, nearing retirement, trying to preserve the capital they've built up over time because now their goals are in sight. The thing that they've been saving up for is now, within reach. So
Yeah.
yeah, we talked about it a little bit, but let's maybe dive in a little bit more there. Like I think, and I know you agree, that's a perfectly good reason to start selling some stocks, to buy whatever, bonds, to keep it in cash, CDs, things like that.
This is like, congratulations, high five, you've done it, right? You've got there. You've got there. You've spent however long doing all the things that we've talked about, creating wealth, holding these stocks for as long as you can, as long as they're delivering and building wealth for you. But now you're at a point where the upside is no longer worth the volatility risk, the downside risk, right? So, just imagine, it's 2007, late 2007, and you're retiring in 2009, and you're like, you know what? The market's really recovered from the dot-com bust. I think I'm just going to ride it out a couple years more. Well, guess what happens if you were that guy? Your portfolio was down almost 60%, right? 60%. You can't retire anymore. It's off the table. Guess what? You got to keep working. Try explaining that one to your spouse, right? Your family. So you have to start moving the upside, chasing the upside. No, you have to, what's the saying? Not risking what you don't need to try to gain what you, not risking what you can't afford to lose
For something that you don't need. Yeah.
for something that you don't need. Exactly.
Yep.
Right. So that's exactly it. So you build in this process. We had Robert Brokamp on talking about investing with and for kids a few months back, and he runs the Rule Your Retirement service for the Motley Fool. And he's a little bit older than we are, Jeff. He's in his early 50s, and he recently wrote something for Motley Fool members that kind of talked about what he was doing, and it really resonated with me. And the idea when you start doing this is it's not like, okay, I'm retiring in 5 years. I want to move a big chunk of my portfolio today. It's like you start doing it like in stepping stones. Like you start creating like a waterfall where you do a little bit this month and a little bit next month and a little bit next month. And the end of that year, you've done 5%. And then you do another 5% the year after that, another 5%. And the next thing you know, you've slowly transitioned a little bit of your asset base out of these volatile equities and created like a cash revenue stream. So, for the next 5 years, once you enter retirement, that cash is going to be there. And then you keep that process going. And then the next 5 years, every year you're adding another year onto the end of it, right? And it's this really powerful thing. Now, that's very likely a process. The reality is that for a lot of people, I'm going to go back to like the 2021 crash, 2022 bear market year that we got. There's a ton of people that came out of COVID and like they maybe retired early or they just chose to retire because of COVID, and they moved their 401k into a rollover and decided to go FOMO gold diamond hands into the stock market. And now they're, and then they went through that period where they lost all that money, and they were building that waterfall after the fact. Now they're following a process now, but they waited too long to do it. So I really want to bring that up and caution people away from waiting too long, because it's so easy. It's so easy to say, let's just wait another year. Man, the market's up 12% already this year. I'm just going to wait a little bit longer. And there be dragons, right? Don't try to sail through those waters.
Yeah. And that's where, again, processes and frameworks and sort of, quasi rules can really save you, just committing like every month I'm going to sell 2% of this stock that's, 10 bagged so that I can start to put it into something safer. I think, we just one last quick thing, then we'll move to the next one, but we're talking about this through the lens of retirement. But I think if you're someone who has been investing for other goals that are now within reach, I think that this is also a perfectly reasonable reason to sell. So I think I'll give you an example just from my life. Like I'm investing for my kids' college through 529 plans, and I'm not touching those because they're in target date funds. They're going to become more conservative as we approach.
Right. They're doing this for you automatically.
Right. I don't need to sell them ahead of time. But if I had decided when I was, 20 that I wanted to start investing in stocks and for my future kids and sell those stocks when they're close to college, like I have a 10th grader, I'd be selling those now.
Right.
I'd be putting them into cash or something safe, because if the market crashes his senior year, I don't want to not be able to pay for college. So that's not the position I'm in, but I could see myself.
For your kids' high school graduation, you don't want to give them a college loan application that you've co-signed.
Yeah, exactly.
Yeah.
All right. So here's another reason that we think could be a very good reason and a smart reason to sell. And this is where it gets interesting, because this is exactly what we said was a bad reason before, except there's an if tied to it. So the stock has not done well, but it's because the business is not executing, the thesis is broken, and then, or the thesis has changed and the new business or the, is not what you were hoping for. It's not what you believe in. Let's talk about that as a reason to sell a stock.
Yeah. So I think the key thing here is we're talking about one thing that's the same. Stock price has gone down, or maybe it's just gone sideways and the market's gone up, right? You've waited for 5 years and there's no value that's been created for you. You had a thesis, you built a thesis over time, you're evaluating the business and it's not doing the thing that you bought the business to do, right? So clean energy fuels is an example, right? The idea of selling more natural gas to offset diesel for trucking and creating, strong per share value and cash flows. Business has done part of that, right? They sell a lot more natural gas than they used to, but they're not making cash flows and they've had massive amounts of dilution. So it's a busted thesis, right? And at some point you have to make the decision. Is it time to move on? Do I want to take what I've got here and now take that other part of my process, which is reallocate this towards places that I have better conviction? And ideally companies that have proven they can win, right? Proven that they can do it. A more recent example, I think, is a good one. And Lord knows we've talked about it enough already. I went on Chit Chat Stocks on their Power Hour and talked about it. That's Boston Omaha, right? So the thesis is clearly busted from what this business was even 6 months ago. The idea of these two jockeys that you can bet on that are going to allocate the money and they're young, the skin in the game. One of them's gone. Guess what? They're not going to go chase a bunch of outside acquisitions anymore. They're not going to fund free market companies that go public and then they make a bunch of money when they IPO. They're not doing that stuff anymore. So the thesis has altered a tremendous amount. So for investors who signed up for the prior and the new idea of a single CEO that's disciplined, that is just reallocating capital and building the existing businesses, by the way, that haven't really delivered great economic returns, that's a perfectly viable reason to say, you know what? I have much better ideas and I don't believe that Peterson is going to be able to create any value for me. And you move on, right? Might be the wrong, maybe he delivers well and you're wrong, right? But you have a viable, valid reason to move on to what you think is a better idea.
All right. So I have a scenario for you and I want your thoughts on it. Okay.
Yeah, you should sell Outset Medical. It's busted.
No, it's nothing to do with that. All right.
I'm not selling Outset either.
There are 2 stocks in my portfolio that I bought way early in my investing journey based on a recommendation in a stock service that I was just incredibly lucky because I was doing all this indiscriminate recommendation buying in 2020, right? So I bought some stuff in like March and April of 2020, just perfect timing at the bottom of that crash, that flash crash because of the pandemic.
Yeah.
Now, those 2 stocks are Arista Networks and Broadcom, and Arista is up in my portfolio 210% and Broadcom is up 170%. And I'm not saying that to brag, it was lucky timing. I have not added to either of those more than maybe one other time since those initial buys during the pandemic.
So the caveat is that because of your investing style at that point, they've done very, very well, but they're still small positions.
Small, and it was luck.
Yeah.
There was no skill or knowledge involved in either of those. Now,
yeah.
Here's my question.
Okay.
They are near the very top of my portfolio in terms of total returns. It's like NVIDIA and them, right? They've done fantastically. So I've obviously not sold them.
Right.
Now, if those same 2 stocks were at the bottom of my portfolio, I can guarantee you I would have sold them by now. Because while I do understand them vaguely, I understand Arista a little bit better than Broadcom. They're not that interesting to me. They don't get me excited. I don't have this like crazy conviction in them. I think they're in a place where they're taking advantage of just kind of secular tailwinds, and that's been part of why they've done so well. Do you think a good reason to sell a stock is it's been crushing it, it's great, but I know if it crashes, I will have no conviction, so I should take my losses, my gains off the table and put that money into something I have higher conviction in?
Well, it gets back to what Tyler said and that's why I think this is so valuable is, do you have enough conviction to at least not sell? And again, in the scenario you're talking about, it doesn't sound like you do. And from what we talked about from the maybe part of a process, doesn't sound like you have the interest to build your own conviction, to understand these businesses, the competitive environment they're in, their competitors, to build your own conviction. I mean, these to me sound like perfect candidates for moving on. If you have a better idea for how to allocate that money, or it's part of some sort of plan, building cash, for example, not just a whim, right? Do you have a specific reason where it fits in something that you're trying to accomplish, where it makes sense to exit them now versus some other point in the future? Yeah, I mean, honestly, this is like perfect example of all of the things that you've talked about trying to do, both concentrate and also have more capacity to expand into things that you're more interested in, right? And to me, it sounds like they're getting in the way of you doing the things that you want to do with your portfolio.
Yeah, it's just I love it as an example because I think when people, I mean, I could be wrong. Listeners can reach out, tell me what they think about this, send us an email or a DM or something. But I think for most people, when they want to sell something, they're going to go look at the bottom of their portfolio, right? They're going to go find the things deep in the red. And that makes sense, right? We do believe in watering your flowers and pulling your weeds. I think it's worth sometimes looking at the top of your portfolio, the things that have done well. If you are looking to put your money somewhere else, like if you do have a high, so the reason I haven't sold is a couple things. I don't, all right, number one, it's done really well. Feels dumb to sell a winner. And I might have enough conviction not to sell. I actually might. Like I could, if one of those stocks fell 50%, I might still hang on to it. I might even add to it because I have this understanding of what their benefits are because I followed it enough because I own it.
Are you sure are you sure you just wouldn't be anchoring on that prior high price?
I might be, but I think,
Yeah.
well, I mentioned a few minutes ago, I believe they both are benefiting from some secular tailwinds, and I don't see those
Yeah.
secular tailwinds going away anytime soon. So like, I think that might be the determining factor. All right, we don't need to go any further into my particular situation here, but I just thought it was relevant to what we were talking about in terms of having a reason for actually selling.
Jeff's
Um,
and thank you for joining us for this episode of Jeff's Portfolio Therapy Corner.
that's right. We can't get too many episodes by without me having some sort of therapy session. So thank you for
Okay.
indulging me. All right. So we've talked about all the reasons for almost an hour now to sell. Let's maybe quickly go through a couple more questions. So
Jeff, before we move on to the next little section here, there's one other thing I want to mention I think is important too. Sometimes the thesis changes and the stock is done spectacular. It doesn't always mean that the business is done bad, right? Sometimes things have just changed. Maybe the business is now very mature and the growth prospects aren't as great as they used to be, but you still have another 20 years that you want to be investing and it's no longer fits as like one of your best ideas. That's the thesis changing as well. Sometimes that's a perfectly good reason to sell a stock as well.
yeah, one that pops into my head in that sense is like Meta,
Yeah.
right? They went so far into the metaverse that they changed their ticker and their company name. So if you were a what we used to be Facebook investor because of the core products, and you're seeing Zuckerberg burn $10 billion a year on metaverse aspirations, that might have been a thesis buster for you, but the stock's done great.
Right.
So,
Right.
but if that's not the reason you owned the stock, that I think that's an example of maybe what you're talking about.
Yeah, no, exactly. That's exactly right.
Hey, everybody, we'll be right back. But first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carries significant risk. Full disclosures and podcast description. U.S. members only. Here's a question for you. As we sort of transition from talking about all the reasons people do sell to maybe some frameworks or checklists or guidelines that we think could be helpful for people as they face that decision point, what's something you think all investors should do before they sell any stock that they own?
Well, we talked about it before, and you've talked about building in friction. And I think that is the single most important thing that every investor should do is introduce time and effort in between you and access to your portfolio, almost to the point of, and I'm big on not having rules and really focusing on frameworks to make you think and not just force things that force you to act in a certain way. But for me, it's basically a rule that I've got to wait at least a market day, sometimes 2 market days. Like if I'm really excited about something, like, no, I, I'll do it Monday to not act, to really temper that emotional drive to act. So I think that's the big one, is building friction into whatever your process is.
I like the friction answer. I also think I'm a big fan of mental exercises and like mental checklists. So I think for me, the thing that investors should do before they sell, I agree with the friction, but I think another thing is ask yourself why you're selling. Have that conversation with yourself. Why am I really selling this? And if this episode can be helpful in any way, maybe go through those things that we identified as, the price wagging the stock or whatever, the things that we identified as being maybe less than good reasons, and ask yourself, is this really why, or am I using it as an excuse? And I think the other thing I would say is the more that you know the reason why you own the stock, the better chance you have to make a smart decision. And I actually don't like the phrase like your thesis for owning the stock. I know we talk about thesis a lot, but that's a word that I think isn't super clear. I like to think of it as like, why do you own it? Right? Like
Yeah.
what's your why for this stock? So I think if I own this stock because of these 3 reasons, or these are the reasons I think it's going to be successful in the future, that can ground you, because then you can ask
Mhm.
yourself, okay, do I want to sell because they're not doing what I thought they would in this in the list of reasons why I own it? Or again, is it an excuse? So that's what I'm thinking in terms of like what you should do before you sell. All right. So let's flip the script then. This is an area we haven't talked about much. I teased it a little earlier, but I think there's some interesting stuff here. What should investors do after they sell?
I think you have to look forward as the starting point. You have money now. You did have an interest in a business. Now you have money. What are you trying to accomplish with every dollar of cash that you're investing? Think about those goals and then allocate that cash accordingly. So I think that's really important. We talked about it before. Whenever you're selling a stock, you're going to be buying something else. And now you don't just have to get that one decision about what you're selling right. You got to get the right decision about how you're allocating that cash into whatever you're buying. You got to get that decision correct as well. So I think it's really important to fall back to your frameworks and your goals, and then act accordingly. And it's going to help you avoid falling down that trap of, you're starting with, oh man, I've got to buy this stock, this new hot AI stock. It's going to go up. Oh, well, I can sell some Amazon. That's done really well this year. Let me sell a couple of shares of that. And then I'm going to take that Amazon and quickly buy it. Right. And you shove all of these actions together, and emotion is driving everything. That if you slow down your whole process, because if you're trying to act that quickly to do it, you're probably acting for the wrong reasons. And emotion probably is driving your decisions, and that almost never works out in your best interest when it comes to buying and selling stocks.
Yeah, I like the idea too, and you wrote this in our notes of like you should have this answered before you sell. Like you should have like the forward-looking thing figured out before you hit the sell button. I think that
Right.
ties into what you're saying.
Well, because
What?
you and I, we text pretty regularly before we buy or sell stocks, just to kind of bounce the idea off of each other. And you and I both are pretty good about playing the contrarian. Even if we already agree with whatever the other person is going to do, we immediately kind of put on that contrarian hat and push back a little bit, challenge the other person. I think it started with me, like the question I would always ask you when I'm thinking about selling X. I'm like, okay, what are you going to do with the proceeds? Like, what are you going to do with it? To kind of think through that. And I mean, it's a perfectly valid answer to say, well, I'm going to buy cash, right? If that's part of your plan, not just your excuse that you're using then in the moment to do that action, then it makes sense. But I agree. Having that already laid out, it's just like with sports. There's a good chance that, if a football team, they probably have the first quarter of the football game, their offensive game plan already sketched out. It's going to change somewhere along the way based on what the other team does. But I think we should do that more as investors, is like be thoughtful about the next steps. You may not use the full plan, but the value of the planning is so, so good, because it keeps you grounded in your process and your goals, and making better decisions versus just reacting and acting to the stimulus that you're exposed to.
Yeah, yeah, I like that. One thing I don't do that I'm thinking of starting to do next time I actually do sell a stock is I really want to track exactly what I use that money for in some formal way. So whether I make a little tab on my spreadsheet where I put like the price of the stock that I sold on that day and then the price of the stock that I bought, and just sort of view it as like a competition for the next couple of years and see like
Yeah.
how each, now that I sell pretty infrequently, I feel like maybe I can do that, or at least even write down somewhere, hey, today I sold this because I wanted to put it in that, and
Yeah.
go back and revisit, not necessarily, for any reason other than to, as a reminder to myself
Mhm.
that if I look back and think to myself like, oh, I made some stupid mistakes, like maybe learn from them, or as a way to see, oh, you're really bad at this. Like if I go back and look and like everything I sold is doubled and everything I bought with that money has crashed, like that could be a nice little break on me to say like, hey, maybe you shouldn't sell so much because you're
Right.
not really good at it.
Well, you know what's
Um,
funny, Jeff, is Google Sheets, you can put letters in there too, not just numbers. So your little process, your quarterly process, if you sell a stock, it's a perfect opportunity if you just track that, because a lot of the companies you sell, you continue to track them from what I understand, right?
yeah. And that's the other thing I wanted to say, which is I think, one of the things I wrote about in the newsletter last week was I like the idea of selling all but one share or all but $100, whatever it is, right? Just so that that stock stays in your portfolio and you see it, either to teach you the lesson you needed to learn, or to keep an eye on it in case you sold it for reasons other than I don't like this business anymore. So
Yeah.
I do think that's a worthwhile thing. And I think there's a mental thing I had to get over of like, I can rebuy something I sold.
Right.
Maybe I just made a mistake, right? Maybe I was wrong and I thought the business was not doing what it was supposed to be, and that, oh, actually I misunderstood and it's actually good. Or maybe I sold for one of those really good money reasons, but I still like the business, and I
I think
think
Meta's a good example of this, right? Because I mean, it's a perfectly valid reason for somebody to say they're kind of killing the golden goose right now by spending all this money on the metaverse, and I don't think that's going to work. So I'm going to sell, and then maybe 3 or 4 years from now, the metaverse hits, and they figure out a way to monetize it. It's like, you know what? I was wrong. I like this business even better. Okay, I'm going to go back in, or maybe it doesn't work out, and they stop burning money and move on, and it becomes back to the original thesis. So that's exactly right. That's the thing. These aren't individual horse races, right? That once the race is done, you can never make that bet again. You can always go back. I'm glad you brought that up.
all right, so that's a perfect segue into the last two things I think we should talk about here before we wrap things up, which is let's each talk about a selling mistake that we've made, and then let's each talk about a sell that we made that we think was smart or good or has worked out. So I'll start because it's actually almost directly related to what we're talking about right now, which is, so for me, the first one that popped into my head was Tractor Supply Company.
Mhm.
So this is a stock that I bought for two reasons. It was, like I said earlier, I bought it earlier on because it was a recommendation in a service I was subscribed to, and I knew it. There are Tractor Supply companies around me. I know that sounds weird because they're a rural lifestyle company and I live in New Jersey, but there's a lot of
Yeah, it's the
farms
Garden
in my
State.
part.
You live in the Garden State.
I do live in the Garden State. So there's Tractor Supplies like on a couple, commute paths that I take various places on a fairly regular basis. And I like being able to see out in the wild the companies I invest in. But back when I was in this frantic way of like trying to get rid of stocks and have less, and I was selling things that for all these different reasons, I sold that one just because I wanted to have less stocks and it was losing at the time. It was down. I think it was down about 20%. And looking back, I regret that decision for two reasons. One, I still like and admire the business. And every time
Mhm.
I drive by Tractor Supply, I say to myself, I wish I hadn't sold that.
Yeah.
And it's also up 63% since I sold it.
Right. Funny
So
how it always
it,
gets back to price movement.
it was, but I mean, my point, I brought up the price and the other reason because, like, for me, here's an example. I also sold Tesla. And if Tesla 10 bags from here, I know I still own it because of Nick's picks. Go back and listen to that episode. Um,
Begrudgingly own it. I'll put the
but
link in the transcript.
let's just say I didn't still own it because of that contest thing that we did. If I sold that and it 100 bagged, obviously I'd be like, well, that sucks. But I actually wouldn't care because I just did not want to own that company anymore for a bunch of different reasons.
Yeah.
The
Yeah.
difference with Tractor Supply was that there were no like other reasons. I like the company. So I just sold it for stupid reasons. So that's the one that pops into my head. What about you? What's a sell you've made that you view as a mistake?
So, and it's two really, I'll put them together because it's kind of the same reason, but Microsoft and Apple. And in fairness with Microsoft, I sold pretty pretty early in Satya Nadella's term as CEO, and he has just fundamentally changed the business. But the reality is that I struggled to see the greater potential, like with the cloud and now artificial intelligence. If you go back to the time that I sold, it's 8 or 9 years ago now. I can't remember exactly when Nadella started, but it was within 2 or 3 quarters of him taking over as CEO. I didn't get it. And I didn't, the mistake I made was not really putting in the time to like putting in the reps to really understand everything they were trying to do, the size of the potential market and the potential there, because I said, okay, Microsoft, giant enterprise software company, can they really get any bigger? And that was my lazy analysis. That was as far as I went. And then with Apple, a little bit of the same thing, but frankly, a little bit with Apple, I'm going to be honest. I've talked a lot about how the multiple expansion's been such a big part of the stock performance over the past few years. Nonetheless, I still failed to see its potential as a multi-trillion dollar, wonderful, wonderful business. Always admired the business. I'm an avid Apple product user, but just couldn't really see the bigger potential. And you mentioned Tesla, and it's the same for me. And we've talked about the challenges I have with Elon Musk and all of that. And that was part of it. And it's been years and years ago since I sold Tesla. I bought in it, I don't know, because they've split the stock a couple times.
Yeah, more than once.
I think split adjusted, I probably paid $3 or $4 a share, Jeff. I mean, it was 28 at the time, but $3 or $4 if you split that back. And a couple things happened. Number one, I follow the auto industry really closely, and I knew eventually Tesla was going to get to a point as a mature automaker where it was susceptible to all of the price pressures and the cyclical challenges and all of those things that have happened. I didn't expect it to happen as quickly as it had, but it was one of those stocks that it kind of dominated way too much of my mind, considering like my actual exposure to it. And always those lingering concerns in the back of my head about once it's successful, what's the next act going to look like? And I hear you right now. I hear all the Tesla bulls out there, Jeff. I can hear them, even though they're not going to hear this recording and make their comments for a week and a half. I can still hear them saying, but AI, but autonomous driving. Sure, maybe like the order of magnitude of difficulty for those things is incredibly high. I don't think enough investors appreciate how hard it's going to be to do those things because they're businesses that don't exist today. They don't exist. So yeah,
Yeah,
no, I don't regret that.
right. So you would classify Tesla as a stock that you think was a smart sell, like that you don't have regrets about that one. Yeah.
Yeah, no, exactly. Because it's
Yeah.
in the too hard pile for me.
Right. And not to talk more about Tesla, but I also feel like if they really do figure out those other things in a truly meaningful way, like if they can be as successful with either AI or self-driving at the same magnitude that they've been successful with EVs, there will be plenty of time to buy that stock if someone wanted to and still probably do fine, because that's how much more it would add to that business's value.
Right.
So for me, I think if we're going to stick with the ones that we think were smart sells, I won't use Tesla because you did. I'll talk about Fulgent Genetics, which I bought and was pretty bullish on. They're a genetic testing company, but they also quickly pivoted to manufacturing COVID tests during the pandemic. And I was really impressed with how quickly they could pivot to do that. And they made billions of dollars just
within weeks. The story's remarkable.
Yeah.
I think they spent like $1 million, and within weeks they had the rapid test ready, and they had the PCR test, the highly accurate one, do it through the mail. Like they figured that out quickly, and they made like $3 billion in cash over the next 3 years.
And they signed like really big contracts. Like they were the tester for the Los Angeles Unified School District in California. I mean, like they made really, but what really impressed me during all that was they kept reporting the growth in their genetic testing business. And that was consistently 250% year-over-year growth, like almost every quarter. It was crazy triple-digit growth. And they were making smart acquisitions in my mind. They were using that cash to buy smaller businesses that would add to their genetic testing. So they very much were able to hold two things in their mind at once, right? Like we have this cash windfall that we know won't last forever, and we're using it to reinvest in our core business. So I was really high on this company. And then two things happened. There was a lot of self-dealing that became apparent through the SEC filings. And as I learned more about that, I became a little bit more concerned about management. And then they went and bought a pharmaceutical company that they used to own, that they split off at the IPO, and it is also owned by their CEO. So to me, that busted the thesis, because as I know from investing in other pharmaceutical companies, like that is a capital intensive cash burn business until you hopefully get something that's commercialized and you can start making money again.
Yeah.
And that combined with the fact that like they bought their own CEO's business from the CEO rubbed me the wrong way, and I got out. So to me, that was one that I think was a smart decision, because it sat with me wrong. The thesis changed, and I was no longer, all my conviction was gone. So now I could be wrong on that one too. Like time will tell. If that stock 10 bags, like, okay, well, maybe that was the wrong financial decision, but I feel like that would have been another one that would have lived in my portfolio where I was too hesitant to add to it, but too scared to
Yeah.
sell it. So I'm
No, I
glad I
get
made.
it. And it's, I love that you brought that one up, because I also own Fulgent, and the difference is I've decided to continue to hold, because as much as I have the same questions and concerns about acquiring the biotech business, and like the insider dealings with closely held businesses that the CEO's wife owns, things like that, those are concerns. I do continue to see pretty decent capital allocation, and the genetic testing business is not growing as much as it was, but it's still generating plenty of cash flows. They still have a ton of cash on the balance sheet, and the way they're steadily allocating that cash towards a couple of higher probability ideas, I like the exposure to that. For me, it still fits in my portfolio, even acknowledging, yes, it's a radically different thesis, and it's a perfectly viable decision to move on, because everything is so much has changed about the thesis.
Well, and that's why I brought it up, because
Yeah.
if I was gonna put a percentage on my sells in terms of like things I sold for what I would now consider to be good reasons versus bad reasons, it would be heavily weighted towards bad reasons. So that's one that I feel pretty confident that I sold for what I consider to be a good reason.
Give me a stock. Let's maybe we start wrapping this up here. What's a stock you're thinking about selling, and why?
Probably if I was going to list two, one would be Etsy. And the reason is the performance has not been well and not done well. And not just the stock price, but the business itself. It has very much flatlined. I'm annoyed with management for two reasons. They use a infuriating amount of corporate speak in their SEC filings and press releases and even their earnings call. You know, they just constantly talk about Etsy's right to win. That's like their like motto or phrase, and it just drives me insane. I just hate contrived consultant nonsense, especially when the business has basically been flat. And they very much,
And you don't have a right to win, so it's entirely
yeah.
unrelatable.
But here's what really bugs me. I don't want to say cherry pick, that's the wrong term, but they won't stop talking about their comparisons to like 4 years ago. And this
Yeah.
is where I feel like it's a little bit of the goalpost moving, because during all the craziness with the pandemic, they saw like a huge spike and then they saw a drop. They would always, like in 2021 and 2022, they would refer back to 2019 as like their benchmark, which I thought made sense because that was a crazy time. And I actually thought that was a good way to look at the business. Okay, let's compare it to 2019. Like, let's see where the growth has been from before the pandemic. And when you looked at it that way, it wasn't so bad. It is now mid 2024, and they keep referring back to 2019.
And they're not doing it to establish a long-term bias. They're doing it to gloss over the past 2.5 years of inexistent growth.
Right. Now, I could be totally wrong. This could just be a longer struggle than I anticipated, and 5 years from now, they could be doing great. I don't know. But I'm annoyed by the company. I'm annoyed by management. And I don't think they have a right to win. And I'm skeptical that they're ever going to be able to pull it out. I think the reason I've not sold yet is I have this vow to myself to not sell in this year. But also, I still do think they have a pretty unique offering with a decent moat around it. Because if you want something that's like handmade and a gift, it's like the number one place to go, where you can get a bunch of different things, right? If you're looking specifically for jewelry, there's jewelry places to go. And if you're looking specifically for something else, or but in terms of like all the different things in one place, like I think they're pretty unique. So like that's my enough conviction not to sell moment right there. And the other one is TWLO, which I just think might be a product, not a company. And I'm going to be 100% honest. I'm entirely still holding it because I think it might get acquired at some point.
It's
Like,
funny.
I feel like that's going to be my exit. Again, both are kind of small positions for me. So
Yeah.
there's no, it's not large opportunity cost to just sort of wait and see. But those are two for me. What about you?
Well, I sold Twilio for that reason already, so
Yeah.
I would definitely support that. So I've got two here. They're both small retailers. The difference is that one is a franchise model and one is company-owned model. So the one that's franchise model, I've been thinking about selling, and this is probably going to make you angry, but it's Winmark Corporation. Yeah, Jeff almost spit water for those that are not watching the video.
I love that company.
I do too, and I like it. I like it very well. And of course, a good friend of ours, Jim Gillies, is a big fan of the business. It's very, very well run. Franchise businesses like this are incredibly high margin, right? For the owner of the franchisor, I guess is the way you describe it. I just, for me, it's a small position. It's expensive. I have no desire to add to it, and I think it's one of those things where it's just time for me to move on, because I'm not going to be disciplined enough with it to keep watch and buy when the market creates better value opportunity. So I think with when market's just designed for me. You want to buy my shares, Jeff? You want to buy my shares?
It depends. What's your cost base? Can I buy them at your cost base?
No, you can't. You can't. And that's the thing. It's done very well for me. It's almost tripled. I've averaged about 19% annualized returns in it, which is wonderful. I've owned it almost 6 years. It's done really, really well for me. I just think it's time for me to move on. It's a smaller position, kind of in the idea of what I talked about. I have less cash available. I don't have a lot of conviction in the business today. So maybe that's one of the ways I can do it. And the other one is CATO Corporation. So anybody that lives in the Southeast and has ever been to a strip mall in the Southeast, you've probably seen a CATO store. They have some other brands too, kind of a discount women's apparel focus. And it's a pretty well-run business. They're in a bit of a decline. They're having to close stores. I think it's the son or the grandson of the owner or the founder who's the CEO, pays a big dividend yield, but financially the results have not been good. I'm holding and being patient for signs that they're going to be able to shrink enough that the economic returns are kind of get better and the cash flows are going to bounce back. But I'm starting to lose patience. So this is what I'm not going to sell this quarter. I'm not going to sell next quarter. But depending on what happens with the economy, it's interesting. If we continue to see a strong economy, but the business continues to struggle, that's me a signal to move on. But if the economy goes into the tank and the stock falls a ton, even though I'm contemplating selling it, it's actually a high quality enough business at the right price. I could see myself actually buying more if the market crashed. But again, barring a steady economy and just a continuing to deteriorate business, I could see myself selling it by the end of the year.
All right. So this has been a long discussion. We've talked about a lot of different topics around selling. We've talked about a lot of different stocks related to this topic. Before we wrap up, I want to just do our quick housekeeping here at the end. If you enjoyed this episode, if you enjoyed this conversation, the single best way to support the show is to give us a rating and a review on the podcast apps, and also send it to a friend. Send a link, recommend it to someone, post it on social media, let the world know that you think this is a valuable podcast for people to check out. We would really appreciate that. We are always looking for feedback from the audience. So questions for the mailbag or just ideas for the show, you can reach out to us in any way you can find us. All that stuff's in the show notes. And two other things, you can check out our website, investingunscripted.com, sign up for our transcript and newsletter. And lastly, if you want more stock talk, if you like when we do that on this show, check out Savvy Trader. We have a portfolio on there, and it's a paid service, and we are making buys in that portfolio each month, and we are talking about them and making content around those decisions. And that's a good place for someone who's looking for more stock talk. We really dive into that aspect of investing on that platform. So we'll keep the conversations about investing and answering the hard questions on this podcast for everyone, and we'll talk a lot more about stocks at Savvy Trader. So check out our portfolio at savvytrader.com. All right, Jason, disclose us.
I think we've done a good job. I just do want to give a hat tip to Bryce from Malmo, Sweden. It's an Apple Podcast user. Thank you for your positive 5-star review. Thank you.
Absolutely.
Okay, as always, Jeff and I love to give our answers around these hard investing questions. Selling is definitely one of the harder ones. And we have a framework, and I hope some of the things we talked about help you reach your decisions. That's the big thing. You have to own your own decisions around selling. Everything you do in investing, you can do it. I believe in you. Okay, my friend. Jeff, we'll see you next time.
See you next time.